Okay, so you want to own a water damage restoration company. The phone rings at 2 in the morning. A homeowner says, water is pouring through the kitchen ceiling, and within minutes you have a crew loading machines into a van. While everyone else in the neighborhood is asleep, you arrive, pull the water out, fill the house with drying equipment, send the bill to insurance, and move those machines to the next emergency. Pipes burst in every economy. Roofs leak whether people are feeling optimistic or not. The customer cannot wait, the job can be expensive, and the demand appears to create itself. That is the dream. Here is the problem. The moment that van leaves your warehouse, you start spending money before you know what the job actually is. You do not know how far the water traveled. You do not know what is hiding behind the wall. You do not know whether the loss is covered, which part of the work will be approved, how long the equipment will stay, or when the money will arrive. The technician is already on the clock. The truck is already burning fuel. The customer wants an answer immediately. The person who may eventually review the bill has not even seen the building. And this is how a water restoration company can look busy from the outside, have machines running in house after house, and still make its owner nervous every time payroll comes due. There is a real flood claim we are going to follow through this story. The building was unquestionably wet. The insurer paid more than $150,000 across 2 payments. Then another amount was requested, and that final dispute did not turn on whether a flood happened. It turned on whether the file could prove, item by item, what the water damaged and what the policy actually owed. That case is the key to this entire business, but it will not make sense until we walk through what happens between the first phone call and the final payment. Start with what you are actually buying. The obvious answer is trucks and drying equipment. You need extraction machines, air movers, dehumidifiers, moisture meters, filtration equipment, cords, hoses, containment materials, safety gear, and somewhere to store all of it. You need commercial vehicles capable of moving people and equipment at the same time. You need software for estimates and records. You need insurance. You need trained technicians who can enter a damaged building at an inconvenient hour and make decisions without creating a second problem. And then you need something harder to see: empty capacity. A normal contractor can schedule work for next Thursday. Water damage does not care about next Thursday. The company has to keep enough people, vehicles, and equipment available for a call that has not happened yet. That means paying to be ready while the phone is quiet. One current restoration franchise places the total initial investment for a full operation somewhere between just under $300,000 and a little over $800,000. That is one franchise system, not a universal startup price, and an independent company may begin much smaller. But it shows why this is not simply the price of a van and a few fans. Could you rent equipment and keep the company lean? Yes. That can work until a regional freeze fills every rental yard at the exact moment your phone starts ringing. Could you operate with one truck? Yes, until that truck breaks down while 2 customers are asking for help. Could one experienced technician carry the early business? Yes, until that technician is already inside one building when the next serious loss arrives. Cheap entry does not remove the capacity problem, it moves the problem to the moment demand appears. Now go back to the house with water coming through the kitchen ceiling. Before your crew can dry anything, somebody has to stop the source. Sometimes that is a plumber closing a failed line. Sometimes the source has already stopped. Sometimes the cause is still active when the restoration team arrives. The important point is that stopping the leak and restoring the building can be 2 different jobs performed by 2 different companies. The homeowner sees water on the floor. Your technician has to find everywhere else it went. A meter touches the bottom of a wall that looks dry. The reading says moisture is inside it. The flooring is lifted at one edge, and water has moved farther underneath than anyone expected. A cabinet face looks normal, but the material below it has absorbed water. The visible puddle is only the part of the loss that stayed where people could see it. That first inspection changes the economics of the job because it changes the job itself. The caller may have described one wet room. The actual problem may involve the room beside it, the floor below it, or material hidden inside a wall assembly. The crew has to identify the source, trace the movement, separate new damage from old damage, decide what may be dried in place, decide what may need to be removed, and establish what the finished condition is supposed to look like. This is also why the company cannot honestly treat every weather-related loss the same way. Water coming through an exterior opening is not automatically assigned one contamination category simply because a storm was involved. The source, the path, the material, the time, the building conditions, and any pre-existing damage all matter. The first visit is not a sales appointment. It is the moment the company begins replacing guesses with evidence, and the clock is moving. The Environmental Protection Agency advises drying wet materials quickly and says mold will not grow in most cases when those materials are dried within roughly 24 to 48 hours. That is guidance, not a countdown clock that makes every building identical. It means delay can make the loss harder to control. Materials can swell, finishes can separate, odors can develop, and the amount of work can grow while everyone waits. So when a company advertises around-the-clock response, that is not just marketing language. The company is selling the ability to make a responsible decision while the building is still changing. Now the job begins to divide into layers. There is the immediate work, arriving, making the area safer, removing standing water, moving affected contents when appropriate, and setting the first equipment. Then there is the drying process itself. Air movers help water leave wet materials. Dehumidifiers remove that moisture from the air. Technicians return to measure what changed and decide whether the plan is working. Some material may remain, some may need to be removed. There may be cleaning, disposal, containment, contents, handling, or specialized precautions depending on the source and condition. And after the building is dry, someone may still need to rebuild what was opened or removed. That last part matters because mitigation and reconstruction can live inside the same company while behaving like two different businesses. Emergency drying begins fast and revolves around equipment, monitoring, and short-term decisions. Reconstruction can involve materials, permits, subcontractors, inspections, customer selections, and a schedule that stretches much longer. This is where people see a large insurance claim and make the first major mistake. Industry data has placed the average insurer loss for water damage and freezing at roughly $13,900 over a recent multi-year period. That does not mean the restoration company receives $13,900 every time the phone rings. That number can include emergency mitigation, damaged flooring, cabinets, drywall, contents, temporary work, and reconstruction. Several contractors may touch the same claim. Some damage may not be covered at all. The total claim is the size of the whole problem. Your revenue is only the part of that problem your company actually performs and can support. And even then, the person asking you to begin may not be the only person influencing what gets paid. The homeowner authorizes the work. An insurance adjuster may review the cause and the scope. A managed repair network may have sent the assignment and may be watching response times or service requirements. A mortgage company may appear on a larger payment. A property manager may be speaking for an owner. A flood policy may apply instead of a standard homeowner's policy. The deductible may still belong to the customer. This is not one transaction, it is several decisions stacked on top of the same wet building. And there is another split hiding inside the same scene. Picture two basements with the same amount of water on the floor. In the first, a supply line failed inside the house. In the second, rising water entered from outside. The rooms may look nearly identical to the crew carrying in extraction hoses. Economically, they can be completely different jobs. Standard homeowners insurance commonly covers some sudden and accidental internal water losses, depending on the policy and the facts. It generally does not cover external flood damage. Flood insurance is a separate product. Gradual leakage, maintenance problems, sewer backup, and other causes can create still more variations. The restoration company does not decide coverage. It still has to decide whether it can safely and responsibly perform the work, explain who is authorizing it, and make clear what happens if part of the bill remains outside insurance. This is why water damage is not a payment category. It is only a description of what the building looks like. The cause of the water can change the policy, the evidence, the people involved, and the path the money takes. That distinction will matter when we return to the flood claim, because a dramatic waterline can prove that water was present without proving that every damaged-looking item belongs to the same covered event. One insurer's current preferred service process shows how this can work. The homeowner selects a participating contractor. The assignment is sent electronically. The contractor responds and prepares an estimate, and the insurer may pay the contractor directly. But final payment can still depend on satisfactory completion and the customer authorizing it. That system can be valuable. A qualified lead appears without the company buying another advertisement or fighting for attention on a search page. The payment path may be clearer. The company may gain a steady source of assignments. But the lead comes with obligations. A large managed repair network currently asks contractors to show restoration experience, financial statements, licensing where required, employee background checks, estimating technology, proper facilities, equipment, personnel, workers' compensation, and at least $1 million in both general liability and automobile coverage. The network is not simply handing out work, It is deciding which companies it trusts to represent the process in a customer's damaged property. That creates a real trade. Independent work may give the owner more control over the relationship and price, but the company has to find the customer, explain payment responsibility, and collect whatever the policy does not cover. Network work may lower the cost of finding the job, but the company accepts tighter reporting, service, and review requirements. Neither lead is good merely because it exists. A good lead is one the company can serve properly, document clearly, and collect at a price that leaves money after the work is finished. Now imagine the company has its best week of the year. 3 substantial losses arrive in 4 days. The trucks stay moving, technicians work overtime, equipment racks empty out, the office begins 3 new files while several older jobs are still waiting for final signatures or review. The owner walks through the warehouse and sees almost nothing left on the shelves. That can feel like success. Then Friday arrives. Payroll is larger because the crews worked nights, fuel costs are higher, more supplies were used, rental equipment may have been added because the company accepted one more call after its own machines were gone. The software bill arrives on schedule. The insurance premium does not care that several invoices are still being reviewed. The jobs may be profitable eventually. The company still has to survive the space between doing the work and collecting the money. This is the part owners miss when they treat revenue as one number. A phone call can become booked work. The inspection can create an estimate. The estimate can become an approved scope. The work can be completed and invoiced. Then the invoice can sit as a receivable until someone actually pays it. The company spends money near the beginning of that chain. Cash may arrive near the end. Emergency restoration makes the gap more dangerous because the company often begins before the final scope is settled. You cannot tell the homeowner to leave the water in the wall until every line item has been reviewed. You have to stabilize the situation, record what you find, and keep the file moving while the physical work continues. Equipment creates the same timing problem in a different form. A dehumidifier sitting on a job is not available for the next call. That is fine when it is needed and tracked. It becomes expensive when nobody knows whether it is still necessary, whether the latest reading was recorded, or when the pickup should happen. A machine can be earning revenue, waiting for retrieval, tied to a disputed file, or simply lost inside a crowded operation, and it looks like the same machine from the warehouse door. The owner is not really managing a pile of equipment. The owner is managing where every machine is, why it is there, what technician is responsible for it, what evidence supports its use, and when it can produce value again. This is where the flood claim from the beginning comes back. The property had a documented water line of about 7 inches outside and about half an inch inside. The insurer first paid roughly $37,500. It later paid more than $118,000 for covered building damage. The policyholder then asked for roughly $38,500 more. The appeal did not succeed. The reason was not that the flood was imaginary. The record showed the water. The insurer had already paid a large amount. The issue was that several additional items were not supported well enough. Some estimates and invoices were not itemized. Some material was not shown to have suffered direct physical loss from the flood. Some conditions appeared to have existed before the event. The evidence did not connect every requested amount to covered damage and a supported repair cost. That was a National Flood Insurance Program case, so it should not be treated as the exact rule for every private homeowner's claim, but it exposes the most important economic fact in this business. The file is part of the job. The photograph showing where the water reached matters. The moisture reading tied to a location matters. The note explaining why material could not remain matters. The equipment record matters. The signed authorization matters. The itemized estimate matters. The evidence showing completion matters. None of that is decoration added after the real work. It is how the company explains the real work to people who are not standing in the room. That changes the way you see the technician holding a camera. The camera is not slowing the technician down. It is preserving the condition before the building changes. It changes the way you see the estimator in the office. That person is not simply turning labor into a larger number. The estimator is connecting a physical condition to a specific reviewable scope, and it changes the way you see the coordinator asking for one missing signature or photograph. That missing item may be the difference between a completed file and a completed job that remains difficult to collect. A machine can dry a room perfectly and still fail to explain why it was there. That does not justify inflated estimates, unnecessary equipment, or pressuring a frightened homeowner into signing something they do not understand. Those shortcuts may create a larger invoice for a moment, but they weaken the evidence, damage the customer, and put referral relationships at risk. The durable company has to show what was needed, what was done, and why the charge belongs to the loss. Once that lands, the biggest question in the business is no longer how many calls you can get, it is how many calls your company can finish all the way through. A regional freeze makes this visible in a single night. The temperature drops, pipes fail across the same area, and the phone starts ringing faster than the crews can return calls. Property managers may report several affected buildings. Homeowners leave messages while every available technician is already on a job. Rental yards empty. The dispatch board fills with addresses. From the outside, this is the moment every restoration owner has been waiting for. From the inside, it can be the moment the company loses control. If the crew rushes the first inspection, the scope starts weak. If machines are placed faster than anyone can monitor them, the records fall behind. If the office opens more files than it can build, invoicing slows. If the company keeps accepting work after its trained capacity is gone, customer service drops at the same time the company's exposure rises. The storm does not only increase demand, it compresses every decision into the same few days. This is why the busiest company is not automatically the strongest one. The stronger operator knows when an emergency call is an opportunity, and when it is a promise the company no longer has the capacity to keep. Storm work can still be valuable, it can produce an extraordinary month, but a company built entirely around waiting for extraordinary events has a fragile calendar. A steadier business may come from ordinary losses connected to repeat relationships. Property managers, commercial facilities, national accounts, agents, plumbers, and managed networks that call the same company because it has responded well before. Those relationships do not remove the need for good work. They make demand less random. One large property services company reported that its restoration brands grew during a year when storm-related revenue was only about half what it had been the year before. The company pointed instead to national accounts, a larger share of existing accounts, and ordinary local work. That does not prove every commercial account is profitable or every storm job is bad. It proves the dramatic event is not the only path to growth. The phone ringing because an entire region is in trouble feels powerful. The same customer calling again because the last job was handled properly can be more valuable. And this is where ownership finally separates from self-employment. Picture the company after several years. The warehouse is fuller, there are more trucks, revenue is higher. The owner is known by local plumbers, property managers, adjusters, and commercial clients. On paper, this looks like a business someone else could buy. Now remove the owner from one Monday morning. Who answers the emergency phone? Who knows which equipment is available? Who reviews the difficult scope? Who speaks to the customer when coverage is uncertain? Who notices that one job has been dry for a day, but the machines are still there? Who follows the unpaid invoice? Who protects the relationship that produced the lead? If every answer is the owner, the company may provide a strong income and still be hard to transfer. The buyer is not purchasing a functioning response system. The buyer is purchasing equipment, receivables, and a collection of relationships that may leave with one person. A valuable operation looks different. The call can be dispatched without panic. The field team knows what to inspect and record. Equipment moves through a visible cycle from storage to job to cleaning and back again. The estimator receives a file that can be defended. The office knows which payment is waiting on a customer, which is under review, and which has become a real collection problem. The important relationships belong to the company because the company consistently performs, not because every client has one person's private phone number. The machines in the two warehouses can be identical. The ownership economics are not. So, does owning a water damage restoration company work? It can work when the company controls the entire path from emergency response to collected payment. It needs enough capital to act before the money arrives, enough discipline to refuse work beyond its capacity, enough technical judgment to find what the surface does not show, and enough documentation to explain the work after the evidence has changed. The failure pattern is almost the reverse. The owner sees a wet building and assumes it is a guaranteed insurance job. More calls arrive, more equipment goes out, the office falls behind, and estimated revenue grows faster than collected cash. By the time the problem becomes visible, the company is not short of work. It is short of usable machines, complete files, and money. That is why the final test is not how loud the warehouse is after a storm. It is whether one call can travel through the company without breaking, from dispatch, to inspection, to controlled drying, to a complete file, to an invoice someone can understand, to cash the company can actually use. Go back to the kitchen from the beginning. The leak has stopped, the floor is dry, the homeowner can use the room again. Your equipment has been cleaned, checked, and sent back out. That physical result is the reason the company deserves to exist. But it is not the whole thing you own. You are not really buying a collection of machines that sit in wet rooms. You are buying the ability to enter a building at its most chaotic moment, find what nobody can see yet, make decisions before certainty exists, and carry that job all the way to a supported payment without losing the customer, the crew, or the company in the process. The machines dry the building. The business is everything that has to go right before, during, and after they do.